Hello, everybody. Welcome to this video. It has been a hot minute since I have posted on this channel, but I am ready to get back into it and to produce that accounting content that you love. Okay, so in this video, I'm going to be talking about a topic that I find that students struggle quite a bit with, and that is debtors impairment. And I'm going to be doing a simple example on how we impair debtors when we have debtors that have gone insolvent or that are being written off. And we're going to be looking at two scenarios where the debt was incurred in the current year and a scenario where the debt was incurred in the prior year. And what I really want to do in this example is just to focus on the journal entries, the adjusting journal entries that are going to be processed at the reporting date. I do encourage you to take this example a little bit further and see if you can produce the general ledger accounts. But that's something you can do in your own time for some fun. Let's get into this example. So in this example, we've been provided information for Millennium traders, and we've been given an extract from the statement of financial position. So this is just showing us what the trade receivables balances are. Now remember, in the statement of financial position, the trade receivables balance is net of any allowance for doubtful debts. Okay, so we would have our gross trade receivables, and in this case, if we just look at the bottom here at the debtors age analysis, here you can see that amount represents the gross trade receivables, and then from that we would subtract the allowance for doubtful debts at the end of the year, which would give us that net figure over there. Okay, so then we are given a debtors age analysis. So just want to talk 2 seconds, about a debtors age analysis. Every business that has customers that are purchasing on credit from them, they would keep a list of all of these debtors, and these debtors balances are going to be aged according to how long the amount has been outstanding. And when businesses calculate the allowance for doubtful debts, what they would do is they would calculate it based on how long the debt has been outstanding, and the longer a debt has been outstanding, the more the greater chance that debtor is not going to be recoverable. So that's just a point on the debtors analysis. But in this question, I'm not going to get into how we calculate the allowance for doubtful debts. I'm just going to indicate here that the allowance for doubtful debts for this financial year, which we're looking at is December X2, has been calculated as 10,450 over year, and I'm giving you the opening balance as well. Okay, so before I move on, I want to touch on this opening balance. Remember that in the prior year, we would have had a debtors list as well, and we would have calculated an allowance for doubtful debts. And really, what this 9,340 represents, it represents an allowance that we are making for debtors that we think are not going to be recoverable in the future. Okay, so in addition to all of these extracts, we are also given some information about things that happened during the year. So the first thing is that at the reporting date, it was discovered that H. was declared insolvent, and the liquidator has indicated that the business would receive 45 cents for every rand owed. Okay, so that means that the debt, right, that H. has incurred is going to partially have to be written off because that's the collectability of the full 100% debt there, or the 32,000, no longer is probable. We are only going to be getting 45 cents for every rand, so that's about 45% of that debt. So we would need to write down the difference, because we cannot reflect this debt on the statement of financial position at the full amount, okay, because our assets cannot be showed at an amount that is greater than the economic benefits that we expect to recover in the future. Okay, so we know that that debt is going to have to be impaired, and then the business also decided to write off the debt of A. McLean that related to sales that were made in 20X1. So if you look at A. McLean over here, we can see that that debtor is outstanding for more than 120 days, and now the business has decided this customer clearly is not going to pay. We are just going to write off this debt. Okay, so what I would like to do now is to just look at the general journal entries that would be processed in relation to these two additional information points over here. Okay, so if we look at the first additional information point, which is the insolvency of H2O, the liquidate has informed us that the business is only going to be receiving 45 cents for every rand. So that means that the business, there's 55 cents in every rand that the business is not receiving. So if we were to calculate the write down, we would calculate it as follows. So we would have the amount outstanding, which is 32,000, and we would multiply that by 55 cents effectively, because that is what is being written off. Okay, so let me just, I'm going to now calculate what this is. Let's do it over here. And so I will do that and that. Okay, yes. Okay, so the full amount that we have to write off in this case is 17,600. Okay, because the difference, so the 32,000 minus that amount over there, the difference of 14,400, that is what we expect to actually receive when the debtors estate has been liquidated. So if we were going to process a journal entry for the write down of the 17,600, okay, let's go and do that. So I'm going to start with my debit and then my credit. Now, because this is a specific debtor, right? We know that this is a specific debtor that has gone bad. We can take our credit directly to the trade receivables. Okay. Oopsie. Okay, we can take that directly to trade receivables because we know that it is a specific debtor that has gone bad, and that would be for 17,600. Now, when we are decreasing or derecognizing a part of the debt, that is causing our net asset value to decrease. And that net asset value is due to a transaction that does not involve the owner. So we know we are going to have to recognize an expense. And in this case, the expense that we would recognize is called bad debts expense. Okay, what's happening over there? Let's put that like that. Okay, it is bad debts expense. Now, I've indicated an element next to that just to indicate that bad debts expense would be recognized in the profit or loss section in the statement of comprehensive income. Okay, so that debt over there would be 17,600. So notice that, let's do it this way. Okay, notice that when we know the specific debtor that has gone bad, we would write that debt off against our trade receivables. Okay, now in the second example, okay, we have a debtor, A. McLean, that is long outstanding, and the business has decided that this amount is not recoverable, so that needs to be written off. Okay, so if we were going to do a journal entry for that, okay, let's see. Now, we know that this is a specific debtor that is being written off, so we are going to, as in the first example, the previous example, we are going to credit the full, we are going to credit trade receivables. And the reason why we credit trade receivables is because this is a specific debtor that we are writing off. Okay, now when it comes to the contra account for that debtor, what contra account are we going to use? Now, this situation is different to the first situation, because in the first situation we can see that that debt right there, which is, it's less than 30 days, that debt has been was originated in the current financial year, which is 20x2. And so we wrote it off to bad debts expense because we are now at the reporting date and we are yet to calculate an allowance for doubtful debt. So any allowance that we calculate would not factor in this debt because we are writing it off. Well, it's partially written off. However, last year, because this debt is coming from the previous financial year, that amount there, that balance of 5,100 was sitting in our trade receivables in the prior year. So it's included in this figure over here. Okay, it's in the prior year. And in the prior year, we would have calculated an allowance for doubtful debts on that amount over there, which was the 9340. So this is the net amount after the allowance, but the allowance that we raised was 9340. And the reason why we raised that allowance was to provide for the fact that in the future we expect some of our debtors may not pay us, so we are now recognizing this allowance, which decreases our trade receivables on the face of the financial statements, so that our assets are at an amount that we expect to be recoverable. But because we've provided this for this debtor already in the prior year, we've calculated this allowance, our debit does not go against the bad debts expense, right? Our debit goes against the allowance for doubtful debts. Okay, and that is because the purpose of the allowance was to provide for something like this happening, and now that that event has happened, we can now take that out of the allowance for doubtful debts. And the element over here for an allowance for doubtful debts, I'm going to put it as a negative asset, and really it is a contra asset because it follows the asset account of trade receivables, and it just reduces it on the face of the financial statements. So that amount there is 5,100. Okay, so in this example, I hope that it has been clear to you and that you now understand how we would write off specific debtors when they are no longer recoverable. Okay, and I hope that the important thing that you should see here is the difference between when the debt originates in the current year and when the debt originates in the prior year. And if the debt has originated in the prior year, remember you've already provided for that. So when you write off that debtor, you would take it out against the allowance for doubtful debts. Okay, so that's all for this example, and I will be back soon with another example on probably again debtors, just looking at allowance for doubtful debts a bit more. But I hope that you enjoyed this video, and I look forward to seeing you in the next one. Thanks, bye-bye.